In this video, we're going to discuss a standard type of non-liquidating distribution in which a corporation issues a dividend to its shareholders. And that dividend could be cash, it could be property, but I just want to talk about the basic rules. So a distribution is going to be considered a dividend to the extent that the corporation making the distribution has substantial earnings and profits, otherwise known as EMP. We're going to talk about what that means in an example in a moment, but assuming that the corporation does not have sufficient EMP or that the dividend is more than the amount of EMP that's available, once the EMP goes to zero, or if the EMP is negative to begin with and there is no EMP, then the distribution is actually going to reduce the shareholder's basis in the stock. So that's after the EMP is exhausted, right? Now, if the shareholder's basis goes to zero and the EMP has been exhausted, then any additional amount of the distribution is going to be treated as a gain on the sale or exchange of property. Now, normally stock held is typically a capital asset, so that would be a capital gain, although that's contingent if it was a capital asset in the shareholder's hands, right? So I want to give an example to make it a little less abstract and easier to understand. So let's say that you purchase stock in a corporation called Crazy Joe's Flying Lessons. You want to learn how to fly an airplane. And so you pay $1,000 for this stock. So that's going to be, we're going to call that your adjusted basis. That's your basis in the stock, and that's going to become relevant in a moment. So your basis in the stock, what you paid is $1,000. And now we need to know a couple of things about Crazy Joe. So Crazy Joe, he has current EMP is 0 for Crazy Joe's, and then there's accumulated EMP of $4,000. So those are the earnings and profits for Crazy Joe's. Now, at some point in the future, maybe the next day or something, Crazy Joe's distributes $10,000 of cash to you, right? So here's Crazy Joe's. This is the corporation, and you are the shareholder, and you are receiving $10,000 cash. You're receiving $10,000 cash from the corporation. Okay, now we're just going to assume this is just a standard distribution covered under Section 301. Section 301 of the U.S. Tax Code. So nothing fancy going on here. We'll just assume it's cash. Just $10,000 cash being given to you. Now here's the question. How does that affect Crazy Joe's? And how does that affect you as the shareholder? What are the tax implications and so forth? So here's how it's going to go. We're going to go back to our little three-pronged strategy here. First, we're going to say, okay, to the extent of any EMP, this is going to be considered a dividend, right? So is there any EMP? Well, current EMP is 0, but there's accumulated EMP of $4,000. So what does that mean? That means that the first $4,000 of this $10,000, so we're going to say, let's say $4,000. So that $4,000 is going to be a dividend. $4,000, right? So now if Crazy Joe's was just distributing $2,000 of cash to you, then it would just be $2,000 would be a dividend, and that would be the end of it. Now, because he's giving you $10,000, this actually brings Crazy Joe's EMP to 0, right? Because the EMP now gets subtracted, goes down to 0. Now, here's the thing about EMP. You're getting $10,000, but once that EMP has gone to 0, it doesn't go, a dividend distribution cannot make EMP go negative. So you are not going to have where you say, oh, now EMP is negative 6,000. Doesn't work like that, right? So these are you can think of EMP as it's basically undistributed profits or however you want to think about it. But basically this has gone to 0 after the first 4,000 is a dividend. So what happens next? Well, now we go to part 2. We say, okay, after we've exhausted EMP, it reduces the shareholder's basis. So now we go back, and now this is why it's relevant of the basis, right? So the basis is $1,000, and so now your basis is going to go to 0, right? So now you have no basis in the stock, right? So now we say, okay, $1,000 reduction in basis. So this is reduction in basis. Now, if you don't know why that's an issue for you or what are the tax implications, just think about it like this. Let's say you sold the stock that later for $9,000, right? So your amount realized is $9,000. Well, you're going to subtract your basis later to figure out what would be your gain. This is hypothetically if you sold the stock in the future. I'm just trying to explain the implications of basis. So 9,000 minus 1,000 would be an $8,000 gain. But now that your basis has been reduced to zero, if you sold the stock for 9,000, then you'd have 9,000 minus zero, a $9,000 gain. So basis reduces the tax you got to pay when you sell the stock, right? So when you reduce your basis, it's basically saying, all right, later when you sell the stock, you're going to have a higher gain. So the reduction in basis is not a good thing for you as a taxpayer. You'd like a higher basis, but so now we've accounted for $5,000, but there's still $10,000 cash that you receive. So we'll say, well, I already reduced the MP to zero. We already reduced your basis in the stock to zero. Well, what's there left to reduce? Well, nothing. So what we have the remaining amount is a gain on the sale or exchange of property. So that's going to be $5,000 gain. Now let's pretend, you're just somebody who just bought the stock. This isn't like inventory or some kind of ordinary asset for you. It's just a capital asset, this stock that you held here. So then in that case, this would be a capital gain. So you're receiving $10,000 from Crazy Joe's flying lessons. Crazy Joe's EMP is now at zero after all is said and done. You have a dividend of $4,000. Your basis in the stock has been reduced 1,000, so your basis in the stock is now zero. And in addition to that, you have a $5,000 capital gain.